There's a lot of talk around leave the UK, move to Dubai, for example, and sell your shares, let's say in your trading company, and you'll pay no capital gains tax at all. Now, that does sound interesting. It sounds amazing. And, it does work. I'm not here to say it doesn't work. However, a big however, I'm not sure if all advisors are speaking about I don't want to call it, is it anti-avoidance? Anyways, there's certain rules called the temporary non-residence rules and capital gains tax. So there's certain rules relating to, this whole thing about leave the UK. Let's just say you leave the UK for one tax year, and then during that tax year, so this is the advice that will be given, during that tax year, you dispose of your shares in the trading company. Now, if they're talking about property investment companies and the rest of it, that you can leave the UK and dispose of your shares in a property investment company or a non-trading company, then I'll just tell you straight that this does not work, okay? Because we're looking at other rules that were introduced in 2017, April 2017, which is around UK situs assets. So UK land and property will still be subject to UK tax. But yes, let's just say shares in a trading company. So, this dream is being sold sometimes that we leave the UK, or just leave the UK, move to Dubai. And I'm just using Dubai because that's where everyone's, that's the hype right now. Leave the UK and dispose of your shares in the trading company, and therefore you pay no capital gains tax. So that is possible. However, I just want to, the reason for this video is to talk about the temporary non-residence rules. And broadly speaking, I'm not going to go into the technicalities, but there are certain conditions that need to be looked at, such as the 4 out of 7 year rule and the rest of it. But if you are a temporary, if you fall foul of the temporary non-residence rules, which means that if you come back and become a UK resident within 5 years from the tax year that you left, then those gains will come back into charge. So that's what you need to be careful about. That's the whole point of this video, to warn you, or to just make you aware of that rule, which is that if you leave the UK, you dispose of your shares in the trading company, let's just say value of shares was 10 million, you would have had to pay 1 million at 10%, balance at 9 million at 20%. So we're looking at about 100,000 plus 9 million at 20%, 180,000. So 9 million at 20%. So yeah, we're looking at about £300,000 tax. It's a bit late, so I don't know if I've got my calculations correct. But anyways, you leave the UK, you don't need to pay that tax. So because the way capital gains tax works is if it's dependent on residency. If you're non-UK resident, no CGT. However, if you return back to the UK, those gains will come back into charge if you return back to the UK within 5 years. So you have to remain non-resident for 5 years. And these are known as the temporary non-residence rules interacting with capital gains tax. When it comes to this whole resident, non-resident, that's where we're looking at the statutory residency tests, which were introduced in April 2013. And then we're also looking at other angles, for example, remittance basis, split year treatment split year treatment becomes quite, I don't want to say problematic, but it becomes relevant when we're looking at this whole temporary non-resident on 5 years and the rest of it. There are conditions that need to be looked at. There are pitfalls that you need to be aware of. So yes, it does work, CGT, generally speaking, if you're non-UK resident, then there's no UK tax payable on your gains. Unless it's obviously UK land or property, which we mentioned earlier. There is another aspect. There are a lot of different angles. The main aim for this video is to just inform you or make you aware of the temporary non-residence rules. But for example, if you were to purchase shares when you're non-UK resident, and then dispose of those same shares whilst you're non-UK resident, and then come back within 5 years, then in that instance, you're not caught by the temporary non-residency rules. Why? Because you purchased the shares after becoming non-UK resident. So there's all that to look after as well. When it comes to overseas aspects of UK taxation, it's very complex, very complicated. It's not as simple as, tell someone move to Dubai and you pay no tax on your disposal. Yes, it perhaps works, but you just have to be careful. There's a lot of angles to look at, even just when you're leaving the UK and when you're returning back to the UK. There's a lot of tax angles to look at. double tax relief, tax treaties between the different countries that are relevant, and other wider angles as well. So my name is Omar. I'm a chartered tax advisor, the highest level of UK tax qualification, regulated by the Chartered Institute of Taxation. If you require any tax advice in relation to personal tax, capital gains tax, international tax matters, inheritance tax, corporation tax, broadly speaking, as a firm, we can look after many tax matters, and you will be in safe hands. Don't forget to like, comment, share, and subscribe. My email address is down below. Our website is down below as well. You can check out our reviews. If you have any questions, leave it in the comments down below. I'll be happy to prepare a video. Obviously, if it's quite complex, then a video doesn't really look too good. But yeah, if you have any questions, do let me know. Speak to you soon. Bye.